The Federal Reserve did it again, another big rate hike. Why did the markets fall? I mean, this was expected. But what I will talk about today will show you a different side of the equation, and you're going to get some information from the CNBCs and the Bloombergs, but I want to get into that extra deep level. That's why you're here. Let's break it down, beginning with this. This comes directly from the Federal Reserve's own website. And you could see the press release, which comes out at 2 p.m. whenever they have their meeting. You get this information at 2 p.m. So there I was, refreshing consistently, finally got it, read through it, and yes, it was what we were expecting. And that was a 75 basis point rate hike, which is 0.75%. That brings the range of the Fed funds rate to 3% to 3.25%. Now that is still low historically, but it is a great increase compared to where we were just a few months ago. So they have been hiking significantly when you compare it in this, last, let's say 10 years, but we have also on top of that, the quantitative tightening, okay? Understand that they are tightening at a rate that they have not been doing in a while. This has just begun in September. So that's one aspect of it, but there's something else. Let me just show you this first. This is another PDF from the Federal Reserve's own website. And through here, you're just going to see all of their projections and what have you. But one that I wanted to note was the second row, and that is unemployment rate. They believe somehow, through all the hiking that they're going to do, I'll show you that in a second, they believe that the highest unemployment rate is going to be 4.4%. Do you believe personally that if they continue to hike interest rates up and up and up, that the highest rate, even into next year and beyond, will be 4.4% on the unemployment rate measured by the U3? If you believe that, please let me know down in the comments. I guess they can just use the BLS and manipulate it in any way they wish, but anyway, that's a different story. Let me know. Here we have it with the Fed Chair Jerome Powell warning it will be very challenging to tame inflation without steep job losses across the U.S. economy after hiking interest rates to 3.25%, the highest level since 2008. They believe that, this is what I want to talk about in a second here, that they have to hike much further. I'm going to show you what's called a dot plot, and that signals what all of the members are thinking, okay? Let me show you this. Powell signals recession may be the price to pay for crushing inflation. Fed raises 75 basis points, signals more to come. No one knows if this will lead to a recession. So what I wanted to highlight here really quickly was that at the 2 p.m. they release a statement. At 2:30, Jerome Powell comes out. He reads a prepared statement and then he takes questions from the reporters. I listened to some of that, and essentially what was happening here was they asked the question, okay, but what are you going to do about the next rate hikes? What is your plan? And he literally talked about, first of all, he said, okay, I will answer your question directly, but first, I just want to say something. And it was weird. It was really off the timing, and it just sounded really unusual. And he said, we will make sure that inflation comes down. We are serious. We're going to do it. And he made this really concerted effort to ensure, before saying what he's about to say, that he wanted to mention that they want to take inflation down. And then he said, we're going to look at the data incoming. We're going to make sure that everything's okay, but want to bring inflation down. Like, he was really stressing that in a different way. Like, usually they just read off the paper. Every time he's just reading off the paper. But for this particular instance, he was kind of off the cuff, and it was exactly what he said at Jackson Hole, which spooked the markets initially. And despite, the market coming up and down and all this during the day, it ended off really poorly. So the expectation that they would be going into future rate hikes, this is going to be all so easy. There's going to be nothing to worry about. We're going to start diminishing them down. This is probably the last rate hike. That really turned around right now as I record this video today. Looking at the next aspect, we get into the dot plot. So I'll show you a couple different charts, but basically the same thing. Essentially what they do is they give an expectation. This is not policy at all. This doesn't really mean anything technically, but just to give you a little bit of what the FOMC members are looking at and thinking about, this is one aspect. So 2022, 2023, 2024, 2025, and beyond. Okay, so what the belief here with that red line is that we are going to be in 2023 to somewhere, depending on where you look, going to be above 4.5% on the Fed funds rate based on where we are today, like looking at today's data and when they project outward, because they're trying to get inflation down to 2%. That's what they say. Then we move into 2024, it gets really sketchy. As you can see, some are saying that it still has to be above 4.5%. Others are saying, oh, we can bring that all the way down to 2.6 or 7%. And then the belief here, this is incredible, is that even longer, past 2025, that they will still be above the target range, sitting at 2.5%. Do you see this? Do you understand that the market looked at this information and said, whoa, it's not going to be taken care of this year? It's not going to be taken care of in the next year? So what does that mean for rates if they stay high? Are they going to actually continue to do this? I mean, are they not going to bring them down even if things are really bad with inflation? Well, that's the way it goes. They got to bring inflation down to 2%. That's what they say. And if we see persistently high inflation, well, of course, interest rates are going to have to remain higher. They could, stop. They could pause. They don't have to increase from there, but it's still too high because of all the debt. Something I talked about in the previous video, and of course, I will talk more about that. Here you can see just another dot plot. This one comes from the Federal Reserve, cropped out of the Fed's projections and what have you, just showing you that the expectation here as we move into next year will be higher interest rates. This isn't it, at least what they say. This isn't it by far. They still have to go literally another percent higher. So we can see what would happen as we go through. What's the next rate hike? Is it going to be 50 basis points? Probably. I don't think they're going to go for the 75 next time, though they might. And then what happens at the next meeting following that, and then so on and so forth. So this is having a direct impact on the bond market. Of course, we see the 2-year and 30-year, when you compare these two together, just imagine for yourself right now, this is the yield curve inversion, by the way. If you were taking a 30-year bond and you're taking a 2-year bond, which one would you expect gives you a higher rate of return? Well, obviously 30 years, because you're going way out. That's something that you would want a higher return from. But the 2-year gives you a higher return. That's how messed up things are, because it's changing so rapidly, okay? And that's happening all around the world, by the way. Okay, now the other aspect here was just showing us that when we look at what's happening with the yield surging for the 2-year Treasury above 4.1%. Now, this was not expected by many people. They said that this wouldn't happen, and yet we are here today. When you see what the Federal Reserve does with interest rates, they projected that out. We knew this already. So, when I see individuals, saying that this would never happen, it's really confusing to me. It really is, because all of the data was there for us. Look here. The longer the Fed keeps rates in restrictive territory, the more likely we'll see major disruptions in capital markets beyond what we are seeing today, with falling valuations and weak IPO activity. The Fed is making capital scarce and expensive, meaning companies who need to find funding in public and private markets will face increasing challenges. That's really important, okay? Because increasing interest rates, quantitative tightening, it spooks businesses, it spooks the financial sector, less money is going to get lent out, credit begins to tighten, and as a result, everything slows down. That's mortgages, that's business, that's the expansion based on debt, which is basically everything here on the corporate side and the personal too. So look at all of this. I mean, it's just incredible. Fed rate hikes paint bleak picture for Southeast Asia currencies. Something I talked about a couple of videos ago, that when the United States increases interest rates and the dollar gets strong, the rest of the world can get that cold. Regional policy rate gaps with the Fed to diverge even more. Currency weakness has weighed on bonds amid foreign outflows. So this is just showing us right now that, like I said, when other countries around the world feel that direct impact, The United States is not going to say, well, you know what, Southeast Asia countries are taking a hit, we're going to turn things around. Obviously not. They are going to go ahead with that, and we can kind of foresee what's going to happen. We know this is probably going to go on for the next few months. So these currencies are still going to be taking a beating, okay? I've talked about this before, but just wanted to highlight that once again because I had brought it up and I thought it was important, but now I'm getting another Bloomberg article coming my way and I wanted to highlight that yet again. This was just talking about what's happening with debt. Look, and you got so much debt. What happens with all the interest on top of that? Well, it gets pretty extreme. The debt current stands at basically $31 trillion. Every increase in interest rate, the federal government's interest expense raises the federal government's interest expense. So far in fiscal 2022, the Treasury has forked out $471 billion just to fund the government's interest payments. Think about how extreme that is. To put that into context, at this point in fiscal 21, the Treasury's interest expense stood at $356 billion. That represents 30% year-on-year increase. And then you extrapolate that out, and it gets much, much worse. As a result of all this, how are they going to fund this? What is the idea here? This is so extreme. This is just showing us where the markets could be at. The bond king, Jeffrey Gundlach, saying, look, it could be 3,000, it could be 3,400. Nobody really knows where this will all end up. But he's suggesting that the Fed is probably going to over-tighten. And then I wanted to show you this because there are many different things out there, like different stats and inflation indicators and different websites that help us. This is one that I think you should check out on occasion. It's the Fed Watch tool. And it's just trying to highlight where we'll be at during this next meeting here. If you can't read that, link will be in the description below, or you can just type in Fed Watch and you'll get that. Target rate probabilities for the November Fed meeting, okay? They're saying that there will be a high likelihood that we go to up, I mean, I just can't believe it, but another 75 basis points. That's what it's saying here. And that would be 3.75 to 4.0. And that's incredible. A November meeting, to see that, I mean, it sounds hard to believe, but look at where we were just a little while ago. Now let me break something down for you. You saw that the Fed went big, right? That's pretty key. Recessions don't happen instantly though. Delayed reaction from interest rate hikes. So they started the interest rate hikes a while ago, and it doesn't immediately cause a recession. That doesn't happen. But it does take time. It starts to move through the economy, and you know that the economy cannot withstand higher interest rates today. It is too weak. Bottoms don't form in the stock market, don't form while the Fed is still hiking rates. So know that. That is a fact. That you're not going to see a bottom while they're hiking. I've seen this degenerate YouTuber out there who is telling people buy now. Well, if the Federal Reserve is still hiking, historically that is an unwise move. Okay? Just watch who the gamblers are and who are actual tried and true investors who are prudent and wise. Okay? Be careful. Yield curve inversion needs to reverse. So what I mean by this is that you get a yield curve inversion happening. You know, I showed you that a moment ago. It isn't when it's inverting that's a problem and that a recession ensues. It's when it actually stops, reverses in the other direction, and that's when you have problems historically, okay? Like I said, it's coming out of that you start to feel it. There's always a delay. And then we have this here just showing us that layoffs may accelerate if rates remain higher for longer. That's pretty serious for a lot of people, despite what the Federal Reserve believes in the 4.4%. I'm not so sure about that, but I just wanted to show you this. All of this information is through the research that I've had. I know you're into that as well. I just wanted to break this down for you quite simply. I hope you appreciate this information. If you did, you've got to subscribe to the channel. I bring you the latest and greatest, whether it's the Federal Reserve or whether it's depth on the financial system on the whole. You got to subscribe. I'll see you on the next one. Take care.